The $50,000 Social Security tax trap that triggers Medicare surcharges. The double trap that eats $50,000. A tiny income move can blindside you twice. First, it pulls more of your Social Security into taxable income, then it bumps your Medicare premiums with IRMAA surcharges. It feels unfair because the rules aren't obvious. One worksheet line decides your fate. Most retirees learn this the expensive way. Not you. I'm going to give you a simple plan to avoid both spikes. You'll get quick wins you can use today, and the biggest lifetime saver near the end. If you remember nothing else, timing and order are everything. Let's start with the two-bucket map that stops surprise taxes before they start. The two buckets framework that stops surprise taxes. If you've ever felt like your income is on autopilot and the tax bill just happens to you, this is why traps spring. You can't control what you don't see. The moment you separate your cash flow into two buckets, taxable and non-taxable, you get the steering wheel back. This clicked for me when a client added one harmless December withdrawal and triggered higher Medicare premiums the entire next year. Here's what we're doing. Bucket 1 is taxable income. That's anything that shows up in your adjusted gross income: IRA withdrawals, pension payments, wages, interest, dividends, capital gains, annuity income, and taxable portions of Social Security. Also in this bucket, tax-exempt municipal bond interest for IRMAA purposes. It's not taxed federally, but it still counts in Medicare's MAGI calculation. The thing most people miss is that Medicare looks at modified AGI from 2 years ago, so a move today echoes later. Bucket 2 is non-taxable or no-impact cash. Think principal you originally contributed to a taxable brokerage account. Selling shares may have gains, but you can also tap cash or cost basis with little or no tax if there's no gain. Also here, Roth IRA qualified withdrawals, they're not included in taxable income. Health savings account reimbursements for qualified medical expenses don't raise AGI. And pure bank cash you've already paid tax on, like a savings account balance, creates no new taxable event when you spend it. Now add one more layer: control versus no control. Some income is fixed, you can't turn it off easily. Social Security checks arrive monthly. Pensions show up like clockwork. Required minimum distributions once they begin must be taken. That's no control income. Then there's flexible income you can dial up or down. IRA withdrawals above the minimum, Roth conversions, selling investments in taxable accounts, timing capital gains, or drawing from a cash buffer. Ranking sources by flexibility is your power move. Let me give you a color code to make this stick. Green means safe to use without waking the traps: Roth qualified withdrawals, HSA reimbursements, existing bank cash, and returning your own principal from a taxable account when there's no gain. Yellow means proceed carefully: selling appreciated investments, interest and dividends, pension income you can't change mid-year. Red means likely trigger: large traditional IRA withdrawals, big Roth conversions late in the year, mutual fund capital gain distributions you didn't plan for, and realizing big long-term gains all at once. Why this matters? Social Security has its own stealth formula, provisional income, that decides how much of your benefit becomes taxable. That formula pulls in half your Social Security plus your other income and certain add-backs. Raise your other income and you can drag more of your benefit into taxation. Separately, Medicare's IRMAA uses modified AGI with add-backs like tax-exempt interest. Hit a bracket line by a single dollar, and your premiums jump for the year. Two systems, two definitions, one result: you pay more than you expected. Here's the shortcut nobody teaches. List your annual spending needs, subtract your guaranteed no-control income, and then fill the gap using green first, yellow second, and avoid red unless there's a clear payoff. For example, if you need an extra $8,000 this year, compare taking it from A. Roth, B. taxable account cash, or C. IRA. The Roth or cash likely keep both provisional income and IRMAA lower. The IRA might push you over a line. Small choice, big difference. Quick win you can do today: move one predictable bill, say insurance premiums or property taxes, into a non-taxable cash plan. That could mean building a 6-month bank cash buffer so you don't need a December IRA top-up that tips you into a higher tier. You haven't changed your lifestyle at all, you just changed the source. Now you might be thinking, what if I need growth and can't live on green only? Totally fair. That's why we blend. Keep a modest cash bucket and taxable to handle surprises, and schedule planned withdrawals from IRAs earlier in the year, small and steady, so you can watch the totals and stop before crossing thresholds. If you remember nothing else, you want control points throughout the year, not one giant decision at year end. Common mistakes to avoid right away. Treating all withdrawals as equal, they're not. Ignoring dividends and interest piling up in taxable accounts, those push income up even if you don't sell anything. Letting mutual funds surprise you with year-end capital gain distributions. Funds announce estimates, check them. Forgetting that tax-exempt interest still counts for IRMAA. Let me show you exactly how to set this up. Grab a sheet. Draw 2 columns, taxable and non-taxable. Under taxable, list IRA withdrawals, pension, wages, interest, dividends, realized gains, annuity income, taxable Social Security portion, tax-exempt interest for IRMAA. Under non-taxable, list Roth qualified withdrawals, HSA reimbursements, bank cash, and principal from taxable accounts when there's no gain. Star your no-control items. Circle your flexible items. That visual is your decision map. Once you nail that, everything else clicks because the next part explains the switch that turns Social Security taxation on and why your one harmless dollar can cost you thousands. Provisional income, the Social Security tax switch. Before we continue, you need to understand the switch that decides how much of your Social Security becomes taxable. This is called provisional income, and it's the engine behind the tax torpedo. Do this wrong, and up to 85% of your benefit is taxed. Do it right, and you keep more in your pocket without changing your lifestyle. Here's what provisional income is in plain English. Start with all your other taxable income for the year, things like IRA withdrawals, pensions, wages, interest, dividends, and capital gains. Add any tax-exempt interest like municipal bond interest. Then add half of your Social Security benefits. That grand total is your provisional income. It's not a line on your 104. It's a worksheet calculation the IRS uses to figure out what percentage of your Social Security is taxable. Now the thresholds, the base numbers that flip the switch. For most filers, when your provisional income is below the lower base, none of your Social Security is taxable. Cross into the middle range and up to 50% of your benefit becomes taxable. Pass the upper base and up to 85% of your benefit becomes taxable. The exact dollar thresholds depend on your filing status. The key idea, as your other income rises, more of your Social Security gets pulled into taxable income. That's the torpedo effect. Let me show you how a single dollar can have an outsized cost. Suppose you're right below the point where 50% of your benefits are taxable. You decide to take an extra $1 from your IRA. That $1 increases your other income, which increases your provisional income. The calculation can pull additional Social Security dollars into taxable income, meaning you're paying tax on more than just that $1. It feels like the rules are punishing you for being $1 over, and in this narrow range, they kind of are. Common misses that trip this switch. Municipal bond interest counts in provisional income even though it's federally tax exempt. People load up on munis thinking they're free. They're not free for this formula. On the flip side, Roth IRA qualified withdrawals do not count in provisional income. That's why Roth money sits in the green lane from earlier. Also, capital gains realized in your taxable account count. Dividends and interest count. Pension income counts. It all feeds the same machine. The thing most people miss is how this interacts with timing. If you take a large IRA distribution in December, you might push provisional income up for the year, and there's no way to undo it once the year closes. That's why small plan draws with checkpoints beat one big late withdrawal. And remember, this is separate from Medicare's IRMAA, which uses modified AGI, but the same behaviors that raise provisional income often raise MAGI too. Let's do a quick practice you can try today. Grab your 3 inputs, estimate your other taxable income for the year, total your tax-exempt interest, and know your annual Social Security benefit. Now compute other taxable income plus tax-exempt interest plus half of your Social Security. That's your rough provisional income. Next, check where that sits relative to the 2 base numbers for your filing status. If you're near a line, you've got a control problem. If you're comfortably below, you have room to maneuver. Here's how to use the switch to your advantage. Sequence your withdrawals so that the dollars you need come first from sources that don't raise provisional income. Roth qualified withdrawals, HSA reimbursements, cash you've already saved. Then if you need more, consider capital gains in the percent long-term bracket if your taxable income allows. Only after those do you draw from your traditional IRA, watching the totals. If you remember nothing else, it's this: when you spend $1, the source matters more than the dollar. A quick micro story. Last week, a viewer had $4,000 left to fund year-end gifts. They plan to pull it from an IRA. We rerouted $2,500 from taxable account cash and $1,500 from a small Roth. The result, their provisional income stayed under the next trigger, keeping more of their Social Security untaxed. Same spending, different source, better outcome. Common mistakes to avoid. Treating municipal bond interest as invisible. It's not in this formula. Ignoring mutual fund capital gain distributions in November and December. Forgetting that provisional income uses half of Social Security, so every extra taxable dollar has a multiplier effect. Quick win: set a personal provisional income speed limit today. Estimate your number, pick a safe buffer under the next threshold, and write it on your one-page map. If you see yourself getting close by Q3, pause IRA draws, switch to green sources, and revisit after January. Once you can see this switch clearly, the next cliff makes more sense. Because the same extra dollar that pulls more of your Social Security into taxation can also push your Medicare premiums higher through IRMAA using a different definition of income and a 2-year look-back. This is where timing and sequencing really pay off. IRMAA, the Medicare surcharge cliff you don't see coming. Now here's where most people mess up. You master provisional income, but Medicare plays by a different rulebook called IRMAA, the income-related monthly adjustment amount. In plain words, if your income is over certain lines, Medicare adds a monthly surcharge to Part B and Part D. It's not a small fee. Cross a threshold by $1, and you're in the higher premium tier for the entire year those premiums apply. The reason this stings is the 2-year look-back. Medicare checks your modified adjusted gross income from 2 years ago, your AGI plus specific add-backs like tax-exempt municipal bond interest. So your 2025 premiums are based on 2023 income. That means a one-time spike from the past can suddenly show up today as bigger monthly bills. There's no gentle slope here, it's a cliff. One step over the line and you pay the higher amount. Step back under it and you drop to the lower tier. Let me back up and make the terms simple. IRMAA uses MAGI, not provisional income. MAGI is your AGI plus a few add-backs. Big one to remember, tax-exempt municipal bond interest gets added back for this test. Only the taxable portion of Social Security counts in AGI, but muni interest gets pulled in on top. That's different from the Social Security formula, which counts half your benefit directly. 2 systems, 2 definitions, don't mix them. So what pushes people over an IRMAA line? The usual suspects. Large IRA withdrawals, Roth conversions, big capital gains, mutual fund capital gain distributions, and the sale of investments in taxable accounts. A sizable one-time event, like selling a business interest or realizing gains during a rebalance, can bump you up a tier for a full year. Home sales over the exclusion limits can do it too. The character of income matters. Interest and dividends in taxable accounts also stack onto MAGI. Here's the game changer nobody talks about. It's a cliff, not a marginal phase-in. In 2026, the first IRMAA threshold is $109,000 for single filers and $218,000 for married filing jointly. Cross a line by $1 and you owe the higher surcharge every month for that year. There's no partial. Concrete example, a married couple projects $217,999 of MAGI for 2026 under the $218,000 line. If they take $2 more from an IRA and land at $218,001, they move into the next tier. For 2026 Part B, that jump can mean a monthly premium step up into the next bracket, ranging from $284.10 up to $689.90 per person per month at the top tier. And Part D adds an extra $14.50 to $91 per person per month depending on tier. One stray dollar can mean hundreds more per month for an entire year. Therefore, you need a personal speed limit under the next threshold and a buffer. Aim to finish the year a few thousand below the $109,000 or $218,000 line based on filing status. That buffer absorbs surprise dividends, capital gain distributions, or a small underreported item that gets corrected later. Let me show you exactly how to stay in control. First, know your current year MAGI estimate. Add up what you've already realized: pension, wages if any, IRA withdrawals, Roth conversions, interest, dividends, realized gains, and any tax-exempt interest. Second, look up the IRMAA tiers that will apply based on your filing status. Third, set that speed limit. Fourth, sequence the rest of your year's withdrawals using our green, yellow, red lens so you don't cross the line in December. Quick win, check your projected MAGI against the next IRMAA tier today. If you're within a few thousand, slow down. Delay elective IRA draws. Shift spending to bank cash, Roth qualified withdrawals, or HSA reimbursements. If you have appreciated positions you plan to sell, consider waiting until January if it keeps you under. Or if you must realize gains now, consider tax loss harvesting to offset them. Don't do what I did the first time and assume an estimate is good enough. Build in that buffer. Before we continue, you need to understand one subtle difference from provisional income. IRMAA doesn't count half your Social Security directly. It counts the taxable portion that shows up in AGI plus those add-backs like muni interest. Practically the same behaviors that raise provisional income usually raise MAGI too, but the formulas aren't identical. That's why we run both speed limits on your one-page map, one for provisional income, one for IRMAA. What if you already crossed? You can sometimes appeal if you had a qualifying life-changing event like retirement, marriage, divorce, or loss of income. That's where Form SSA 44 comes in. You document the event and your reduced current year income. If it's accepted, your premiums can be adjusted. It's not a guarantee, but it's worth knowing the path. Otherwise, your best move is to reduce next year's MAGI with smart timing, fewer taxable draws, deferring gains, or using qualified charitable distributions once you're eligible. This clicked for a viewer who did a big December Roth conversion and forgot about a mutual fund's capital gain distribution. The combination nudged them just over the tier. The fix the following year was simple sequencing. Smaller conversions spread earlier in the year, harvesting a loss to offset a gain and paying a one-time expense from bank cash instead of the IRA. Same goals, less income crossing the line, no surcharge tier. If you remember nothing else, remember this: IRMAA is a cliff with a 2-year echo. Plan your year with a buffer, check your totals quarterly, and use flexible income sources when you're near a line. Once you nail that, everything else clicks, because timing and sequencing are how you control both the Social Security tax switch and the Medicare surcharge cliff at the same time. The sequencing order that lowers taxes and surcharges. This next part separates beginners from pros. The order you pull money from your accounts changes both your tax bill and your Medicare premiums. Same dollars, different sequence, different outcome. Once you learn the logic, you'll stop guessing and start steering. Why sequencing matters is simple. Every source of income touches provisional income and MAGI differently. If you start with the least loud sources and save the loudest for last, or spread them intentionally, you can fund your life while staying under both speed limits. It's not about deprivation, it's about timing. Here's the general order that works for most retirees, especially once Social Security starts and you're on Medicare. First, use cash already sitting in checking or savings. Spending cash you've already earned doesn't create new income. Second, use qualified Roth IRA withdrawals. They don't raise provisional income or MAGI. Third, tap your taxable account in a tax-aware way. Use cash inside the account, draw from high basis lots, and realize long-term gains only to the extent you can stay in a favorable bracket without crossing your limits. Fourth, fill the rest with traditional IRA or 401k withdrawals, taken in planned amounts that fit under both your provisional income and IRMAA speed limits. Now, before Social Security and Medicare, think ages 60 to 64, the order shifts. This is your lane for Roth conversions and IRA draws at deliberately higher levels because there's no IRMAA yet and provisional income doesn't matter if you aren't taking Social Security. In that window, many people lead with traditional IRA withdrawals or conversions up to a target tax bracket, then use taxable and leave Roth for last. Once you turn on Social Security or hit Medicare, flip to the quiet first sequence again. Let me show you how to blend withdrawals so you stay under both limits. Start your year with a plan, estimate your guaranteed no-control income, then set your 2 speed limits. Now allocate your living expense gap across sources. Example, you need $60,000 to live on. You're getting $28,000 from Social Security and $12,000 from a pension. That leaves $20,000 to fund. You might take $8,000 from taxable account cash, $5,000 from a Roth, and $7,000 from a traditional IRA. Why this mix? The cash and Roth keep MAGI lighter while the modest IRA draw maintains tax diversification without pushing you into the next tier. If you see you're ahead of pace mid-year, you can dial down the IRA and lean on Roth for a month or two. Now here's where most people mess up. They treat all spending the same. Split your year into micro buckets, your monthly paycheck and your one-time income events. Your monthly paycheck should come from quiet sources, bank cash, small taxable draws, and if needed, a small IRA drip set on auto pay early in the year. Your one-time events, car replacement, roof, family gift should be planned with timing. If you're close to a limit, schedule that one-time event for January of the next year or fund it from Roth or HSA reimbursements instead of the IRA. Let me give you a quick case sketch. A couple needed $15,000 for a kitchen update. In November, their projected MAGI was already within $2,500 of the next IRMAA tier. If they took $15,000 from the IRA, they'd blow the limit and pay higher premiums all year. Instead, they used $9,000 from taxable cash, sold $3,000 of a high-basis ETF with almost no gain, and pulled $3,000 from Roth. Result: project done, no IRMAA jump, and their provisional income also stayed under the next Social Security taxation bump. A few practical tips to make the sequence stick. Front-load your planning, set your monthly paycheck in January and revisit quarterly. Use specific lots in taxable accounts. Selling high-basis shares means less gain shows up in MAGI. Schedule small, even IRA draws early. Watching totals monthly gives you time to course correct. Keep a 6 to 12 month cash buffer so you aren't forced into a December IRA withdrawal. Common mistakes to avoid. Doing big Roth conversions in the fourth quarter after dividends and fund distributions hit. Ignoring the character of gains. Short-term gains raise taxable income more painfully than long-term gains. Letting interest and dividends balloon in taxable accounts. If they're pushing you over, consider moving yield-heavy assets into tax-deferred accounts at your next rebalance. Here's a quick win you can do today. Set a personal speed limit for both provisional income and MAGI with a $3,000 to $5,000 buffer under the next tier. Write those two numbers at the top of your one-page map. Then pre-assign your next 3 months of withdrawals, quiet sources for the monthly paycheck, and a plan for your next one-time purchase that keeps you under the line. If a surprise shows up, pivot to Roth or cash for that month and reassess next quarter. Once you nail this sequencing, everything else clicks because the yearly checklist we're about to build runs on this exact logic: quarterly checkpoints, pre-planned sources, and small adjustments before anything breaks. The annual IRMAA-Speed limit planning checklist. Once you've got sequencing set, you need one habit that keeps everything in bounds: a short, repeatable yearly checklist. One review per year stops surprise bills next year. Think of it like setting cruise control with quarterly checkpoints so small drifts don't turn into premium surcharges or a Social Security tax torpedo. Start with the goal. You're going to pick 2 speed limits for the year: a target MAGI for IRMAA and a target provisional income for Social Security taxation. Both get a buffer. Then you'll run a simple 4-quarter rhythm: estimate in Q1, adjust in Q2, checkpoint in Q3, lock down in Q4. Add 2 tools to your kit: a basic tax projection and a Medicare premium estimator. And know this form number by heart in case life changes mid-year. SSA 44. Let's set the limits. Pull last year's tax return. Note your AGI. Add any tax-exempt municipal bond interest that didn't appear in AGI. That sum is your MAGI baseline for IRMAA. Now look up the IRMAA tiers for your filing status. Pick a target tier and set a buffer, ideally $3,000 to $5,000 below the line. Write that number at the top of your one-page map as IRMAA speed limit. Next, set your provisional income limit. Estimate this year's other taxable income, add tax-exempt interest, and add half of your expected Social Security benefit. Compare that result to the 2 Social Security base numbers for your filing status. Choose the lower side of the line you want to stay under and set a buffer. Write that number right next to your IRMAA limit as provisional speed limit. Now the quarterly rhythm. Q1, estimate. In January, list your no-control income for the year: Social Security, pension, annuity, and any required minimum distributions. Add known interest and dividend estimates from your taxable accounts. Plug those into a quick tax projection to see your preliminary MAGI and provisional income. If you're already near a limit, change your default paycheck sources right now. Lean on bank cash, Roth qualified withdrawals, or HSA reimbursements for a few months while you recalibrate. If you plan any Roth conversions this year, pencil in a preliminary target cap that keeps you under both limits. Q2, adjust. By April or May, you'll have actuals for Q1 interest, dividends, and any realized gains. Update your tally. If you're running hot versus your speed limits, reduce elective IRA draws and pause conversions. Consider shifting spending to taxable account cash or high basis sales with minimal gains. If you're comfortably under and you intend to convert to Roth, this is a good window to convert a slice while avoiding crowded year-end distributions. Keep your buffer intact. Q3 checkpoint. Summer is when mutual funds start publishing capital gain distribution estimates. This is the mistake most people make. They ignore those estimates and get hit in December. Scan your holdings. If a fund is projecting a large distribution, consider swapping to a similar ETF or a more tax-efficient fund before the record date, or harvest losses elsewhere to offset. Rerun your MAGI and provisional income projections with updated numbers. If you're within $2,000 of a line, pull back on IRA draws for the rest of the year and plan one-time spending from cash or Roth. Set calendar reminders for your Medicare open enrollment review, and note any eligibility for qualified charitable distributions if you're at RMD age. Q4 lockdown. By October, dividends and fund distributions are more predictable. Finalize your year-end plan. If you still want to convert to Roth, only convert up to your cap, don't round up. If you need to raise cash, focus on selling high-basis lots or using existing cash positions. Defer elective gains to January if crossing now would break your buffer. Schedule any large expenses for the new year unless there's a clear tax reason to do them now. Confirm you've met any RMD requirement, and if you give to charity, consider sending a qualified charitable distribution directly from your IRA to reduce MAGI. Let's add the key tools. Use a simple tax projection, your tax software, a CPA, or a trusted calculator to translate your plan into estimated MAGI and taxable income. Use a Medicare premium estimator or the Social Security site to see the IRMAA tiers for your filing status and how far your buffer goes. Keep Form SSA 44 on your radar. You can appeal IRMAA after a qualifying life-changing event. SSA 44 recognizes these 8: work stoppage or work reduction, retirement, divorce, death of a spouse, marriage, loss of income, significant decrease in income, and significant decrease in income-producing property. If one applies and your current income is lower, you can use SSA 44 to request an adjustment. It's not a magic wand, but when a life-changing event applies, it's the right path. Common mistakes to avoid this year: ignoring required minimum distributions and scrambling in December. Forgetting about capital gain distributions in mutual funds. Doing a big Roth conversion after unexpected dividends push MAGI up. Letting tax-exempt bond interest quietly erase your IRMAA buffer. A quick win today. Set calendar alerts for the second week of January, May, August, and October labeled Speed Limit Check. In each, jot the 3 numbers you'll update: year-to-date MAGI estimate, provisional income estimate, and your remaining buffer to each limit. If either buffer drops below $2,000, switch your next month's cash needs to bank cash or Roth and pause IRA draws until next quarter. One last tip that saves headaches: create a standing distribution watch note for each taxable fund you own. In August and again in October, check the fund company's distribution estimates. If a fund is about to throw off a big capital gain and you don't want it, swap it before the record date. It's a simple move that can keep you under both limits without changing your lifestyle. Stick to this checklist for 1 year and you'll feel the difference. Fewer surprises, cleaner decisions, and premiums and taxes that match your plan, not the other way around. Roth conversions without the penalty hangover. Now that your speed limits are set, let's talk about the move everyone hears about: Roth conversions, without stepping on the IRMAA landmines or the Social Security tax switch. Roth conversions can future-proof your taxes, but done carelessly, they spike MAGI, raise your Medicare premiums 2 years later, and pull more of your Social Security into taxable income. The goal isn't convert everything. It's convert deliberately up to the edge, not over. Here's the simple framework. Picture a conversion lane that sits below 3 lines: the top of your chosen tax bracket, your IRMAA tier threshold, and your provisional income comfort line. You convert inside that lane. If any one of those lines is threatened, you slow down or stop. That way you're trading a known, controlled tax today for potentially lower lifetime taxes without triggering an expensive premium year. Timing is everything. The best months to convert are the ones when your other income is low. That often means years before you start Social Security and before Medicare starts at 65. Ages 60 to 64 are prime because IRMAA isn't on the table yet. After you start Social Security and Medicare, conversions can still work, you just need tighter guardrails. That's where quarterly checkpoints and buffers do the heavy lifting. Let me show you exactly how to size a conversion. Step 1. Estimate your current year MAGI from all sources. Step 2. Mark your IRMAA-Speed limit with a buffer. Step 3. Choose your target tax bracket ceiling. Many people use the top of the 12% or 22% bracket as a cap, but the right ceiling is personal. Step 4. See how much room is left before you hit either ceiling. That remaining room is your preliminary conversion lane. Convert up to that amount, then stop. If your buffer shrinks later, say a mutual fund throws a surprise distribution, you still stay under. Now here's where most people mess up. They bunch conversions in December after interest, dividends, and distributions have already landed. That's risky because you're guessing at your total year. Spread conversions earlier in the year, then top off a small amount in Q4 if your buffer allows. And avoid converting in the same year you realize big capital gains or sell a home above the exclusion. Stack those events, and IRMAA shows up 2 years later like a bill you forgot to pay. Let's compare two paths. Path A, one big $80,000 conversion in a single year. It may push you into a higher tax bracket, trigger a higher IRMAA tier, and pull more Social Security into taxation if you've already claimed. Path B, 4 annual conversions of $20,000, each sized to stay below your bracket ceiling and IRMAA line with a buffer. Path B usually wins. Lower blended tax rates, fewer premium surcharges, and far less stress. Bracket management is the engine. The reason this works is simple. You're moving pre-tax dollars into a tax-free account at a chosen rate today, so future RMDs are smaller and your taxable income later is lower. That can mean lower IRMAA exposure in your 70s and 80s and less of your Social Security getting taxed. But remember, every conversion dollar is ordinary income now. If you remember nothing else, remember, convert for a reason, not out of habit. A quick micro story. A couple at 64 with no Social Security yet had a $25,000 lane up to the top of their target bracket. We converted $20,000 in May, left a $5,000 cushion, and then reviewed in October. A bond fund announced a larger than usual distribution, so we skipped the top off. Result, no IRMAA issues at 65, and their RMDs at 73 will be thousands lower than the do-nothing path. Common mistakes to avoid. Converting late in the year without knowing your total dividends and distributions. Ignoring tax-exempt bond interest that still adds back for IRMAA, it eats your buffer. Forgetting that conversions raise provisional income once you're on Social Security. Converting during a year with big, unavoidable income events, space them out. How to apply this next? Set a conversion cap that aligns to your speed limits. Write it on your one-page map as max conversion this year. Then schedule 2 windows, one in spring, one in early fall, to execute partial conversions. In each window, confirm your updated MAGI, your provisional income estimate, and your remaining buffer. If your buffer is under $3,000, skip the conversion and try again next year. 2 pro tips that make this easy. First, with taxable accounts, use specific share lots to fund taxes on the conversion with minimal gains, or earmark a cash reserve for the tax bill so you're not creating new taxable income to pay for it. Second, if you're charitably inclined and at RMD age later, remember that QCDs can lower MAGI. Another reason your future self will thank you for right-sized conversions now. For 2026, you can make up to $108,000 in qualified charitable distributions per person per year directly from an IRA. QCDs can also satisfy RMD dollars without increasing MAGI. Do this, and you'll get the benefits of Roth, tax-free growth, and flexible withdrawals without the IRMAA hangover or the Social Security tax torpedo. Damage control if you already crossed a cliff. Okay, so the spike already happened. Maybe a late-year Roth conversion, a surprise fund distribution, or a home sale pushed your MAGI over an IRMAA line. Breathe. You can still cut the cost, shorten the damage, and set up next year to be cleaner. The goal now is simple. Reduce next year's MAGI, fix withholdings so cash flow isn't painful, and pace future draws so you stay under your speed limits. First, triage the situation. Pull last year's tax return and your year-to-date income numbers. Confirm which IRMAA tier you tripped and when it will apply. Remember, IRMAA uses the 2-year lookback, so a 2023 spike affects 2025 premiums. Note your 2 current speed limits, IRMAA MAGI and provisional income. We're going to create room under both. Next, lower next year's MAGI where you can control it. Start with discretionary sources. Pause elective IRA withdrawals beyond your required minimum, if any. Delay non-essential realized capital gains in taxable accounts. When you do need cash, prefer quiet sources, bank cash, Roth qualified withdrawals, and HSA reimbursements for qualified expenses. In taxable, sell high basis lots to minimize gains. If you must sell appreciated positions, pair those gains with tax loss harvesting. Realized losses can offset realized gains dollar for dollar, and up to $3,000 of excess net losses can reduce ordinary income with the rest carried forward. Now fix your withholding and estimated taxes so the surprise doesn't compound. If last year's spike created a big balance due, adjust IRA withholding or make quarterly estimated payments to smooth cash flow. The idea isn't to overpay, it's to avoid penalties and a second unpleasant April. If you plan to reduce IRA draws this year, reduce withholding there and consider using taxable account cash to cover any remaining tax bill without creating new income. Here's where an appeal may help. If the spike was tied to a qualifying life-changing event, you can ask Social Security to adjust your IRMAA using Form SSA 44. SSA 44 recognizes 8 events: work stoppage or work reduction, retirement, divorce, death of a spouse, marriage, loss of income, significant decrease in income, and significant decrease in income-producing property. The form lets you document the event and your lower current year income. It's not for market gains or a voluntary conversion, but when one of these applies, it can reduce premiums sooner. Gather proof, employer separation letters, pension changes, or other documentation that supports the drop. Let's add a few tactics that work fast. If you're charitably inclined and at RMD age, use qualified charitable distributions, QCDs, directly from your IRA to charity. QCDs can count toward your RMD and don't increase MAGI. That's powerful when you need to push income down without changing your giving. If you're below RMD age this year, hold appreciated securities and taxable longer and harvest losses where available to create an offset bank for future gains. Consider the timing of big expenses. If you're near a line, push optional one-time purchases into January of the next year or fund them with Roth or bank cash instead of IRA draws. For home projects, car replacements, or family gifts, split the funding over 2 tax years. That simple split can keep you beneath the cliff both years instead of over once. A quick micro story. A viewer realized a large capital gain from a mutual fund's unexpected distribution and then converted to Roth in December, 2 hits. Their premiums jumped for a year. The fix: the following year they moved from the distribution-heavy fund to a more tax-efficient ETF before record dates, harvested a loss in a different holding to offset planned gains, and paid for a $7,500 roof from bank cash instead of an IRA. Result: MAGI fell back under the tier, their buffer returned, and no surcharge the year after. Common mistakes to avoid during damage control. Chasing the loss by doing another big conversion to get it over with, that stacks income again. Selling low-basis taxable positions without checking specific lots, creating unnecessary gains. Ignoring mutual fund distribution calendars, record dates matter. Forgetting that tax-exempt municipal bond interest still adds to IRMAA MAGI, shrinking your buffer. Here's a simple month 1 action plan. 1. Update your one-page map with real year-to-date totals and your remaining buffer to the next tier. 2. Switch your monthly paycheck to quiet sources for 90 days, bank cash, small taxable draws with minimal gains, or Roth. 3. Set a no new gains rule unless they're paired with losses. 4. If you qualify, prepare an SSA 44 appeal packet now rather than waiting. 5. Schedule a Q3 distribution check on every mutual fund you own and pivot if a large payout is projected. And here's your quick win today. Pick one lever you'll pull this month. Examples: move a planned IRA draw to January, harvest a targeted loss to bank against future gains, swap a distribution-prone fund to a tax-efficient alternative, or fund a gift from Roth instead of pre-tax. One lever now can save hundreds in taxes and potentially thousands in premiums next cycle. Finally, pace your future draws. Set small, monthly IRA withdrawals early in the year, not a lump in December. Watch totals quarterly. If your buffer gets thin, say under $2,000, pause pre-tax draws and switch to Roth or cash for the next month. That simple pacing shift turns cliffs into guardrails. Mistakes happen. What matters is turning one bad year into a smarter plan the very next one. RMD's Taming the Mandatory Tax Bomb. Now let's talk about the clock you can't ignore: required minimum distributions. RMDs are forced withdrawals from most traditional retirement accounts starting at age 73 for many people today. The IRS didn't give you a tax break forever, they want their cut. Once RMDs begin, you must take at least the required amount each year or face steep penalties. And those dollars land as ordinary income, which can push up both provisional income and MAGI, lighting up the Social Security tax switch and the IRMAA cliff at the same time. Why this matters is simple. Years of pre-tax saving can turn into a large IRA balance. Even a modest percentage withdrawal on a big number creates a big taxable event. Miss the planning and your RMD can push you into a higher tax bracket, pull more of your Social Security into taxation, and bump you over an IRMAA tier for a full year. Get ahead of it and you can smooth the impact, keep premiums predictable, and control your taxes. Here's RMDs in plain words. The IRS calculates an annual minimum based on your prior year-end balance and a life expectancy factor. You can take it anytime during the calendar year in one lump or in installments. The important part, it has to be out of the account by year-end to count. Roth IRAs don't have RMDs during your lifetime. Traditional IRAs, SEP IRAs, simple IRAs, and most employer plans do. That means the red lane income is coming, so we plan around it. Before RMD age, your best lever is shrinking future RMDs. That's where pre-RMD Roth conversions come in. Converting slices from 60 to 64 or even 65 to 72 with tight buffers moves dollars from the future RMD pool into Roth, where there are no lifetime RMDs and no provisional income or MAGI impact when you later withdraw. The result, smaller required amounts later, which can mean fewer IRMAA surprises in your 70s. After RMD age, you've got two practical tools. First, timing. Spread the RMD over the year in monthly or quarterly installments. Why? You get checkpoints. If dividends run hot or a fund announces a capital gain distribution, you can slow RMD draws temporarily and fund a month from cash or Roth to keep under your speed limits. Second, charitable giving via qualified charitable distributions. If you're 70 or older, QCDs sent directly from your IRA to a qualified charity can count toward your RMD but don't increase MAGI. For 2026, the QCD limit is up to $108,000 per person per year. That's a quiet way to meet the rule, potentially satisfy RMD dollars, and protect your IRMAA buffer if you already give. Sequencing around RMD season is where most people slip. Don't stack a year's RMD on top of an unplanned gain in December. Instead, set a simple rhythm. Plan to satisfy, say, 75% of your RMD in equal monthly payments through September. Re-estimate your MAGI and provisional income in early October. If you've got room, finish the last 25% in 2 scheduled transfers. If you're tight, pause the final chunk and cover spending from taxable cash or Roth until you see year-end distributions, then complete only the remaining required amount. This pacing keeps you on the right side of both lines. Let me give you a case sketch. A retiree had a $500,000 IRA and a first RMD around $18,000. In October, their MAGI projection sat about $4,000 under an IRMAA tier. A mutual fund announced a larger-than-normal capital gain distribution, narrowing the buffer to $1,800. If they took the remaining RMD all at once, they'd cross the tier. The fix? They sent a $3,000 QCD to their favorite charity, which satisfied part of the remaining RMD without raising MAGI and spread the rest over November and December while using taxable cash for 2 bills. Result: RMD satisfied, no IRMAA jump, and provisional income stayed below their Social Security tax trigger. Common mistakes to avoid with RMDs. Waiting until December to start. That removes your ability to adjust. Forgetting that state taxes and withholding can be set per distribution. Use withholding to smooth cash flow, but don't overshoot. Ignoring spouse coordination. 2 RMD streams can combine to push you over a line. Stagger timing and use QCDs where it helps most. Taking the RMD from the wrong account type. Each IRA's RMD can be aggregated within IRAs, but employer plans generally must be satisfied separately. Keep the rules straight so you don't miss a requirement. Here's your quick win. Estimate your first RMD now, even if it's a year away. Take last December 31 balances, apply the IRS life expectancy factor, and write the dollar estimate on your one-page map. Then draft an offset plan. Identify how much you'll convert pre-RMD this year without breaking speed limits. Decide whether QCDs fit your giving, and set a monthly RMD draw starting in January of your first RMD year. Add calendar reminders for Q3 distribution checks and an October lockdown review. One more pro tip. If you hold yield-heavy assets in taxable and they're crowding your MAGI, consider shifting some of that yield into your IRA and moving more tax-efficient holdings into taxable at your next rebalance. It won't change the total return, but it can lower the income that shows up in MAGI before the RMD hits, preserving buffer. If you remember nothing else, remember this: RMDs are mandatory, but the tax and premium pain is. Shrink them before they start, pace them when they arrive, and use QCDs and smart asset placement to keep both provisional income and IRMAA in bounds. Income that doesn't wake the trap, safe streams. This is where life feels calmer. You still get income, but you don't wake the Social Security tax switch or trip IRMAA by accident. Think of these as your quiet lanes, the streams you can use freely when you're near a line or anytime you want predictability without surprise bills. First quiet stream, qualified Roth IRA withdrawals. Once you're over 59.5 and past the 5-year rule, Roth withdrawals don't raise your adjusted gross income, so they don't inflate provisional income or modified AGI. That makes Roth the perfect shock absorber for one-time expenses, month-to-month gaps, or late-year surprises. If you remember nothing else here, Roth dollars are your mute button. Second, HSA reimbursements for qualified medical expenses. If you've got old receipts, you can reimburse yourself tax-free years later. That's cash in your pocket with no AGI impact. Important: once you enroll in Medicare, you can't contribute to an HSA anymore, but you can still withdraw for qualified expenses at any age. It's a powerful tool during IRMAA-sensitive years because medical costs are frequent and large, and this lets you cover them without noise. Third, principal from a taxable brokerage account when there's little or no gain. You already paid tax when you earned that money. If you sell high-basis shares or use existing cash in the account, you can raise spending money with minimal or zero new taxable income. The trick is to use specific lots and target high basis so the realized gain is tiny. Quiet cash, same lifestyle. Fourth, a simple CD or treasury ladder in your taxable account. The goal is predictable cash flow. Set maturities monthly or quarterly to match your budget. When a CD or T-bill matures, you spend the principal and treat the interest carefully in your plan. Interest is taxable, yes, but the principal returning to you is not new income. That split lets you fund most of a month quietly while managing the small interest line in your estimates. Fifth, a dedicated bank cash buffer, 6 to 12 months of needs. I know cash doesn't earn much, but its job isn't growth. It's to keep you from tapping IRAs in December or selling investments on a bad day. The moment you have this buffer, you gain year-round control. Bills show up, your income totals don't jump. Now a caution that saves headaches. Safe doesn't mean invisible. Interest from bank accounts, CDs, and treasuries still lands in your taxable income. Dividends in taxable accounts do too. These are yellow lane items. They're steady, but they can quietly crowd your IRMAA buffer if you don't monitor totals. Keep yield-heavy holdings mostly in tax-deferred accounts when possible. In taxable, favor more tax-efficient ETFs or equities with qualified dividends you've planned for. Let me show you exactly how to set up a quiet income stack. First, build a 3-bucket cash system inside taxable. A checking spend bucket for the next 60 days, a high-yield savings buffer bucket for the next 4-10 months, and a CD treasury ladder reserve bucket for months 11-24. Every month, you refill checking from savings. Every quarter, a rung in the ladder matures and refills savings. You get predictability without selling at bad times or pulling from your IRA when you're near a line. Next, add a Roth shock bucket. Earmark a small target, maybe $5,000 to $10,000 for truly one-time items, a flight to see family, a deductible surprise, a roof repair. When you spend from this, your tax picture stays quiet. Then replenish it next year when you're comfortably under your speed limits. A micro story to make it real. A viewer needed $6,500 for dental work in October. Their projected MAGI sat $1,900 under the next IRMAA tier. An IRA withdrawal would have pushed them over. Instead, they paid $4,000 from a CD that matured that month, principal, and $2,500 from a Roth. The only taxable line was the small CD interest already in their plan. Result: no IRMAA jump, and their provisional income stayed controlled. Common mistakes to avoid. Treating all fixed income as harmless. The interest is small but cumulative. It can erase your buffer if you aren't tracking it quarterly. Forgetting specific lot selection in taxable. Selling low basis shares turns quiet into loud income fast. Letting mutual fund capital gain distributions surprise you. If you want quiet, prefer ETFs or funds with low distribution histories. Using Roth as the first dollar every month. It's a shock absorber, not a permanent paycheck. Blend it sparingly to extend its value. Quick win you can do today. Build a 6 to 12 month cash buffer so you never need an emergency IRA withdrawal in Q4. Then set a small, simple CD or treasury ladder to mature every month or quarter for the next year. Finally, tag a modest Roth reserve for the next unplanned bill. With those 3 moves, you've got a quiet income stack that keeps both the Social Security tax switch and IRMAA asleep. Here's the payoff. When your monthly needs are funded by quiet streams, you can choose exactly when to realize gains, which IRA months to draw, and how to size Roth conversions without tripping cliffs. Sequencing gets easier, your buffers stay intact, and tax season feels boring in the best way. Build your one-page income map. Let's turn everything into one page you can glance at and make a good decision in 30 seconds. No spreadsheets, no tax code citations, just the right boxes in the right order. Start with the top row, your monthly needs. Write 3 numbers: essentials, discretionary, and one-time surprise. For example, essentials $4,000, discretionary $1,000, surprise $300 averaged monthly. That gives you a clear monthly target. Multiply by 12 to get the annual target you'll fund with your income mix. Next row, fixed, no control income. Add Social Security, pension, annuity payments, anything you can't dial down easily, total it. Subtract that from your annual target. The difference is your gap to fund. This single number drives all your choices. Now build your sources in 2 columns, quiet and taxable. In the quiet column, list bank cash, CD, treasury, ladder maturities, principal, Roth qualified withdrawals, HSA reimbursements. In the taxable column, list traditional IRA/401(k) withdrawals, Roth conversions, interest, dividends, realized capital gains, tax-exempt interest that counts for IRMAA, and any one-time income items you expect. Star the items you can control month by month. Circle anything already scheduled or contractual. Add your 2 speed limits across the top margin: IRMAA MAGI limit with your buffer and provisional income limit with your buffer. Write them as bold lines. IRMAA limit X, buffer Y, provisional limit A, buffer B. Beneath each, add a running year-to-date tally row you'll update quarterly. MAGI to date and provisional to date. On the left side, add a small calendar column for 4 checkpoints: Jan, May, Aug, Oct. Next to each month, leave a space to note 3 things: current MAGI estimate, current provisional estimate, and remaining buffer to each limit. This forces quick reviews on schedule, not after something breaks. Now pencil in your monthly paycheck. Use the quiet column first. For each month, allocate from bank cash and ladder maturities to cover essentials and part of discretionary. If you need a bit more, add a small taxable account draw using high basis shares. Only then schedule a modest IRA drip if required to fill the rest. Keep IRA draws even and early so you can watch totals and pause if a limit gets close. Below that, add a one-time events row. List any planned big expenses: travel, car, projects, gifts. Put target months next to them and assign the source now: Roth for a portion, maturing CD principal for another chunk, and taxable high basis sales if you still have buffer. If an event would push you near a line, add an arrow to January of next year. That arrow is your built-in timing fix. On the right side, add a distribution watch box. List each mutual fund in taxable with an August and October checkmark line. You'll write in estimated distributions when they're published and decide whether to hold, harvest losses elsewhere, or swap to a more tax-efficient fund before the record date. Under that, add a conversions lane box. Write your max safe Roth conversion amount for the year based on your buffers. Split it into 2 windows, spring and early fall, with checkboxes. Include a small top-off box for Q4 that you only check if buffers are still intact after dividends and distributions. At the bottom, add a red zone alert strip. Write 2 numbers: IRMAA buffer trigger and provisional buffer trigger. Example, alert if buffer $2,500. Next to each, add 3 actions you'll take if triggered: pause IRA draws, switch next month's funding to Roth/bank cash, defer gains, or pair them with harvested losses. Pre-writing those actions removes hesitation when time is tight. Time to practice. Fill a sample with rough numbers. Suppose your annual need is $60,000, fixed income is $40,000, so your gap to fund is $20,000. Your quiet sources can cover $12,000 via ladder maturities in cash. You plan $4,000 from Roth across 2 months and $4,000 from a small IRA drip. Write that mix into monthly boxes, done. Now stress test with a $5,000 surprise in October. Which sources cover it without breaking buffers? If your MAGI buffer is thin, assign $3,000 from a CD maturity principal and $2,000 from Roth. If your Roth is low, swap $2,000 to bank cash and top the Roth next spring. Common mistakes this map prevents. Forgetting the 2 speed limits when funding a one-time purchase. Converting to Roth after distributions hit because there was no spring window. Selling low-basis lots by default. Add a use-specific lots reminder next to taxable sales. Letting interest and dividends outgrow your plan. Track them in your quarterly tallies. Quick win: create a red zone highlight on any month where your projected buffer will dip below your alert level. If a month turns red, switch that month's funding to quiet sources and push elective gains to a later month or next year. You're not changing your lifestyle, you're just changing the source and timing on one page. Keep this map visible, update it in 5 minutes each quarter. With one sheet, you'll decide faster, avoid cliffs, and keep both the Social Security tax switch and IRMAA under your control. The sneaky add-backs that push you over. Before we continue, you need to understand the small leaks that sink the ship. You can have the perfect plan, then one harmless line item gets added back and boom, you're over your IRMAA tier, or you flip the Social Security tax switch. These add-backs aren't obvious, but once you see them, they're easy to control. Start with tax-exempt interest. The thing most people miss. Municipal bond interest is generally federal tax-free, but Medicare adds it back when calculating MAGI for IRMAA. So if you've been leaning on munis and taxable because they don't hit taxes, they might still eat your IRMAA buffer. For Social Security's provisional income, munis count too. Bottom line, munis are not invisible. Track the dollar amount and budget it into your speed limits. Next, dividends and capital gain distributions. Even if you don't sell anything, your mutual fund can distribute gains to you in November or December, and that shows up in taxable income. ETFs tend to be more tax efficient, but not always. The shortcut: in August and October, check your fund company's distribution estimates. If a fund is projecting a big payout, you can switch before the record date to a similar ETF or a lower distribution fund. That move alone can keep you under a tier without changing your investments dramatically. Now, capital gain distributions versus your own realized gains. Your own sales you can control, use specific lots, target high basis shares, and favor long-term gains. But distributions from active mutual funds are out of your hands once the record date passes. That's why your distribution watch box on the one-page map is there. 2 quick checks per year, and you avoid a surprise that lands right when you're finalizing Roth conversions or RMDs. Here's a big one: IRA deductions versus conversions. Don't cancel your own savings. If you make a deductible traditional IRA contribution while also doing a Roth conversion, the deduction lowers current MAGI, but the conversion raises it, often in the same year. Worse, if you also have other pre-tax IRA dollars, the pro rata rule means your conversion isn't purely after tax. The practical advice: pick a lane for the year. If you're converting, avoid new deductible IRA contributions that muddy the waters and push MAGI right back up. If you need the deduction, maybe skip the conversion until a cleaner year. Watch K1s from partnerships and certain funds. These arrive late and can include unexpected income items, depreciation recapture, or adjustments that increase AGI. If a K1 typically shows up in March, you can't plan last year's IRMAA buffer with it after the fact. Consider moving K1 heavy holdings into tax-deferred accounts, or keep them small enough that a surprise won't break your buffer. Home sale math matters. Yes, the IRS lets you exclude up to $250,000 of gain if single, or $500,000 if married, filing jointly on a primary residence, when you meet the ownership and use tests. But gains above that exclusion are taxable and flow into MAGI. Downsizing can be the right call. Just model the portion over the exclusion so you don't accidentally spike a 2-year IRMAA surcharge. Charity strategies can either help or hurt, depending on form. Donor-advised fund gifts of appreciated securities can avoid realizing capital gains and reduce future dividends from those shares. Quiet win. But selling first, then gifting cash realizes the gain and raises MAGI. After RMD age, QCDs directly from your IRA are even quieter. They satisfy RMD dollars without increasing MAGI. Use QCDs when you're giving anyway. A few under-the-radar add-backs and quirks. Savings bond interest used for education can be added back for MAGI in some contexts, and it's taxable if you don't meet the education exclusion rules. If it's on your return, it counts in AGI. Foreign earned income excluded from tax can still get added back in certain MAGI calculations. If it's on your return, assume it can affect MAGI. Net investment income taxes and AMT don't change MAGI by themselves, but the income that triggers them usually does. So if you're in NIIT territory, your IRMAA buffer is probably thin already. Common mistakes to avoid. Holding high distribution mutual funds in taxable out of habit. Reinvesting distributions automatically and ignoring the tax line they create. Assuming muni funds keep you under the radar. Mixing deductible IRA contributions with conversions in the same year without modeling the pro rata impact. Let me show you exactly how to diffuse these add-backs. 1. List your expected interest, dividends, and fund distributions in Q1, then update in Q3 when estimates are published. 2. Move chronic high distribution funds to tax-deferred accounts. Use tax-efficient ETFs in taxable. 3. If you need more fixed income in taxable, consider treasuries and CDs for predictability. Track the interest line in your map. 4. If you're giving to charity, decide now, appreciated stock gifting or QCDs after 70.5. Both lower future add-backs. 5. For home sales, run the gain math early. If a portion exceeds the exclusion, plan your other income around that year to protect your IRMAA tier. Quick win today. Scan last year's 1099s. Total your muni interest, ordinary dividends, qualified dividends, and capital gain distributions. That number is your silent income engine. Write it on your one-page map and subtract it from your IRMAA buffer right now. If the remaining buffer is small, pivot this quarter. Reduce elective IRA draws, delay taxable gains, and consider a fund swap before the next record date. Small moves now stop big surcharges later. 2 scenarios before and after age 65. Let's make this practical with 2 clean playbooks. Your plan changes around age 65 because Medicare and often Social Security enter the picture. Use the scenario that matches your stage and tweak the numbers to fit your map. Scenario A, age 60-64, pre-Medicare. This is your prime window for Roth conversions and trimming future RMDs because IRMAA doesn't apply yet and provisional income is usually irrelevant if you haven't started Social Security. The goal is to intentionally raise income to a chosen ceiling without triggering avoidable taxes. Monthly income mix. Fund your essentials from taxable account cash, a small CD or treasury ladder, and high basis sales with minimal gains. Avoid large IRA withdrawals for spending, save that space for conversions. Keep a 6 to 12 month cash buffer topped up so you aren't forced to sell during market dips. Annual conversion cap. Choose the top of your preferred bracket. Many use the top of the 12% or 22% bracket and leave a safety buffer for dividends and small gains. Convert in 2 tranches, spring and early fall. Skip the Q4 guess and cross your fingers routine. If you're still working part-time, coordinate earned income so the combined total stays under your cap. Capital gain timing. If you have appreciated positions, realize gains up to the edge of the % or 15% long-term capital gain bracket only if it doesn't crowd your conversion lane. Use specific lots to harvest gains strategically, harvest losses in other holdings to bank offsets for later. Results versus a do-nothing plan. Smaller IRA balances by 65, lower future RMDs, more Roth flexibility in retirement, and fewer IRMAA headaches later. Quick win. Run a simple tax projection to see how much room you have this year for conversions without crossing your bracket ceiling. Scenario B, age 66-72, Social Security and Medicare on. Now the game is staying under 2 speed limits, your provisional income trigger and your IRMAA tier. The focus shifts from aggressive conversions to precision sequencing and buffers. Monthly income mix. Design a quiet paycheck. Start with bank cash and ladder maturities for most months, then layer in a small, even IRA drip early in the year that fits under both limits. Keep Roth as your shock absorber for one-time needs, not a permanent paycheck. Track interest and dividends each quarter. If they're crowding your MAGI, rebalance so yield-heavy holdings live in tax-deferred accounts. Annual conversion cap. Conversions can still help, but only inside your conversion lane beneath your IRMAA line and provisional income comfort line. Convert small amounts in spring, reassess in August after fund distribution estimates, top off in early fall only if your buffer remains at least $3,000. If your buffer shrinks after October dividend announcements, skip the top off. Capital gain timing. Prefer January for larger elective gains so you have the whole year to pace IRA draws and conversions around them. In taxable, sell high basis lots to minimize realized gains when raising cash. Use tax loss harvesting to offset any gains realized mid-year. RMD coordination, if applicable late in this range. Spread RMDs through the year, check projections in October, and use qualified charitable distributions after age 70.5 to satisfy part of RMDs without raising MAGI. That's how you protect your IRMAA buffer while keeping your giving intact. Results versus set it and forget it. Fewer months paying higher Medicare premiums, more Social Security sheltered from taxation, and a smoother tax bill. Quick win. Today, write your 2 limits at the top of your 1-page map with buffers, then assign sources for your next 3 months. Quiet first, IRA drip size to stay under both lines. How to choose your scenario today. If you're under 65 and not on Social Security, pick Scenario A. Your 3 moves this year. Define your conversion lane, set 2 execution windows, and build the 12-month cash buffer. If you're 66-72 with benefits on, pick Scenario B. Your 3 moves this year. Set your IRMAA and provisional speed limits with buffers, lock a quiet paycheck plan for the next 6 months, and create an August and October distribution watch habit. 2 quick micro stories. Pre-65 couple. They converted $22,000 in May, planned $8,000 in October, then skipped the top off when a fund projected a big payout. By 65, their IRA was smaller and they avoided an IRMAA tier 2 years later. Post 65 single filer, needed $9,000 for travel in November. MAGI was within $2,400 of the next tier. We funded $6,000 from a CD maturity principal and $3,000 from Roth. No surcharge and provisional income stayed below the next switch. If you remember nothing else, before 65, build room for your future. After 65, protect your buffers with quiet income and tight timing. Pick your scenario, write your 3 moves, and put them on your map today. Rapid-fire mistakes to avoid and what to do instead. Let's speedrun the costliest traps and the simple swaps that fix them. Don't bunch Roth conversions in December. Do spread them earlier in the year. Why? December is when dividends and mutual fund capital gain distributions land and you're guessing at totals. Instead, convert in spring and, if your buffer allows, a modest top-off in early fall. Leave the 4th quarter for confirming distributions and protecting your buffer. Don't ignore mutual fund capital gain distributions. Do use ETFs or low distribution funds in taxable accounts. The thing most people miss: you can owe gains even if you didn't sell anything. In August and October, check your fund company's estimates. If a fund is about to throw off a big distribution, switch to a similar ETF before the record date or harvest losses elsewhere to offset. Don't pull Social Security too early without a plan. Do run the math with your income map. Starting benefits early might pull more dollars into taxable income if your other sources are loud, and it can crowd your IRMAA buffer when RMDs start. Coordinate the start date with your sequencing and conversion windows. Sometimes delaying benefits gives you a clean runway for conversions in your early 60s. Don't forget QCDs once you're eligible. Do use them to lower MAGI after age 70.5. If you give to charity anyway, send dollars directly from your IRA as qualified charitable distributions. They can count toward your RMD and don't increase MAGI, which preserves your IRMAA buffer and keeps the Social Security tax switch calmer. Don't treat municipal bond interest as invisible. Do budget it into your IRMAA and provisional income limits. Muni interest is federally tax exempt, but it's added back for IRMAA and included in provisional income. Track the dollar amount from last year's 1099 and subtract it from your buffer from day one. Don't ignore specific lot selection in taxable. Do sell high basis shares first. When you need cash, choose lots with the highest cost basis to minimize realized gains. Fewer gains means more buffer for Roth conversions or small IRA drips without tipping over an IRMAA tier. Don't realize short-term gains when you can avoid it. Do wait for long-term treatment when practical. Short-term gains get taxed like ordinary income, which can quickly crowd your speed limits. If you're months away from the one-year mark and the position's stable, wait to cross into long-term territory. Don't forget the 2-year lookback for IRMAA. Do plan big events 2 years ahead. Selling a business, a rental, or a home above the exclusion can hike premiums later. If you can split taxable events across calendar years or time them before age 63, you may avoid a painful IRMAA year. Don't mix deductible IRA contributions with conversions haphazardly. Do pick a lane each year. A deductible contribution lowers AGI, but the conversion raises it, and the pro rata rule makes conversions messy if pre-tax dollars exist. If you're converting, avoid new deductible IRA contributions unless you've modeled the impact. Don't let yield-heavy holdings balloon in taxable. Do place them in tax-deferred accounts when possible. Interest and non-qualified dividends steadily eat your buffer. In taxable, favor tax-efficient ETFs or qualified dividend equities you can plan for. Don't take your entire RMD in December. Do spread it and checkpoint in October. Monthly or quarterly RMDs give you the ability to pause if distributions run hot. In October, recheck your MAGI and provisional income. If you're tight, finish the minimum and shift spending to quiet sources. Don't pay a tax bill with new IRA withdrawals that create more income. Do pre-fund taxes with cash or targeted taxable sales of high basis lots. Or adjust withholdings on early year IRA drips to smooth cash flow without extra taxable spikes in April. Don't assume all safe income is silent. Do track interest and dividends quarterly. Bank interest, CDs, and treasuries add to taxable income. Plan them in your map so they don't erase your buffer by Thanksgiving. Don't forget mutual fund record dates. Do act before them. Swapping after the record date still gets you the distribution. Put distribution watch on your calendar in August and October to decide early. Don't wing it. Do write your 2 speed limits with buffers at the top of your 1-page map and update quarterly. The map forces decisions that protect your limits before the cliffs. Quick win, choose one. Don't, you'll stop today. Examples: cancel that December conversion habit, move a distribution-prone fund before its record date, or set your August and October distribution watch reminders right now. One change can save you hundreds in taxes and potentially thousands in Medicare premiums next cycle. The one-sentence takeaway plus clear next step. Here's the takeaway. Control the order and timing of your income, and you avoid the Social Security tax switch and IRMAA cliffs without changing your lifestyle. Now download the 1-page income map, set your 2 speed limits with buffers, and schedule your 4 quarterly check-ins. Subscribe so you don't miss the next video where we build the advanced Roth conversion ladder, step by step with live examples. Bonus Q and A Bank, fast answers to common but what about? Rapid-fire answers coming next: spouses, home sales, COLAs, gains, appeals.